Hi, everyone. Thank you for coming. I'm Lindsay Dutch, an equity analyst with Bloomberg Intelligence. And for those that don't know, that's Bloomberg's research arm. And we do have a handout in the back if anyone's interested to take one home to learn some more. Today, John Worth of Nareit is going to give us an overview of the environment here in the U.S. And then we're going to move into a moderated Q&A where we're going to compare and contrast those trends, key takeaways here at REITweek with those in Europe and Asia with our colleagues here from Bloomberg Intelligence. But first, I'm going to hand it over to John.
Thanks, Lindsay, and thanks, Lindsay and Jeff, for organizing this session. And thanks to all of you for delaying cocktail hour by at least an hour. It's been a long couple days, obviously, and a busy couple of days. We've got about 2,500 people here at REITweek, so I think another very successful REITweek. And obviously a lot of interest, a lot of interesting questions, a lot of interesting conversation happening in the company presentations. And all of this happens against obviously a very uncertain economic backdrop. Obviously, we're going to have a busy week next week with both the Federal Reserve meeting and possibly taking a pause on rate increases, possibly going ahead with another 25 basis point rate increase, and that will be really colored by an inflation report that's gonna come out on the 13th, the first day of the Federal Open Market Committee meetings, and I think that's that really sort of highlights kind of the key stress that we've got right now, which is the Fed's ability to continue to moderate inflation. The latest read was at 4.9%, and their ability to moderate inflation with or without tipping the U.S. economy into a recession. The last jobs report was surprisingly strong. We saw job creation really right up at the 12-month average for the last year. We did see the unemployment rate pop up a bit, wage growth moderate a little bit. But still showed really surprising strength, which I think means we've got a ways to go to get inflation down to 2% if that's the target, and certainly 3% would be probably where the Fed might be satisfied. So and against that environment, REITs have been obviously dealing with higher interest rates as well as concerns about slowing demand. And that has impacted REIT valuations pretty dramatically. Last year, REITs year to date are up just a bit as of this afternoon. And public-private valuations, which I know we'll talk about in a little more detail, those have really widened out. I think the important thing to note, and certainly something that came through in a lot of the discussions I heard here over the last 2 days, is really two factors. One, that REIT operational performance has continued to be strong. We have seen strong year-over-year growth in FFO in Q1, strong year-over-year growth in same-store NOI in the Q1 results. Occupancy rates really have not slipped, and the balance sheets continue to really be intact. And I know that's been the source of a lot of questions in the company presentations. But today we see REITs with still with low leverage, below 35%, mostly fixed rate debt, and nearly 7 years weighted average term to maturity. So we feel like the REIT industry writ large is really in a good place to be resilient through a period of higher interest rates. So with that, let's talk about what's going on around the globe.
Yes, yeah, we want to dive into a lot of those key topics: valuation, debt levels. We want to start a little bit on the sector side and maybe some of the sectors that have some of the strong fundamentals that you referenced. So I'm going to bring in my colleagues, Sue Munden, who's a senior analyst, property analyst out of London and covers the European markets, and Patrick Wong, who's a senior analyst, property analyst out of Hong Kong, who covers the Asia markets. And we're going to start a little bit thinking about industrial. Obviously, one of the stronger sectors. We're seeing continued rent growth, solid demand. Supply looks like it's dropping off a little bit, which could pave the way for continued rent growth next year. It might still be a little bit lower than the peak, but each of you maybe can talk a little bit about what you're seeing in your respective markets as it relates to demand trends and therefore rent growth. And Sue, maybe we'll start with you.
Yeah, sure. Let's just move this over. So in the European logistics market, I don't know how many of you went to Prologis, but I wouldn't disagree with a lot of what they were saying. So they're still seeing very strong rental growth. One of the companies in the UK that has a March year-end reported 11% year-on-year rent growth to March. So that's still continuing, and the operations are strong. However, what happened to the pricing of the shares last year was driven quite a lot by Amazon. I'm sure you're all aware in the second quarter last year, Amazon came out and said they thought they had some excess capacity and the market didn't like it very much. And so that started the downward trend. So there is concern over whether this structural tailwind that the logistics companies have had as we move to online commerce, whether that's about to start tailing off. And there's a statistic that I always look at, which is in the UK we've got the online, not the penetration, but just actually the sales volume, and that always peaks hugely in the fourth quarter. And we saw a peak in December 2020, and the peak for 2022 was 14% below that. So that says to me that the stock of logistics space that we have can cope with online retail already. And the year-on-year to this April is flat. So that part of the demand may start weakening off. The companies themselves aren't saying that yet, but what they are saying is that they're getting a huge diversity of different customers. So it's not just the retailers, the 3PLs, and e-commerce that's populating their logistics property. They're also getting data centers. They're also getting, certainly in the more sort of urban or surrounding urban space, the restaurants, storage. They've got, I went to a Ferrari showroom, all sorts of different occupiers, which I think they're helping with. So they're still saying the demand is quite strong. I think there's some question marks over that. And there is also a big disparity between what's happening in the urban space and the larger out-of-town logistics hubs. So urban is hugely supply constrained all across Europe. It's really, really difficult to get the space. And to give you sort of slight example of a city in London, for example, over the last 20 years, 24% of what was designated industrial space has gone to residential and other uses. So trying to claw some of that back is really difficult, and that's obviously creating a lot of pricing tension as well. So that's sort of where we are in Europe. Sorry, do you want me to?
Yeah. So I think for Asia, we also see a couple of interesting trends, especially we also having the online retail sales as a percentage of the total retail sales numbers. And what we found that in some market like China, for example, is already 20% plus, right? So which is already factor in quite strong logistics demand there. But interestingly, we also see some market like Australia that in the past, I think is just like starting from low single digit quite a bit of years ago, and then now it's going to about 10%, and we still see the trend is going up further. And this also means that for logistics demand, we could see potentially a very strong momentum going forward. And we also see a couple of players there, like for example, Goodman. I think they are doing pretty good in terms of lots of like warehouse logistics operations in terms of the development. And also in terms of leasing, I think they're also doing pretty good. So that definitely is something that we could see going forward that they're keep doing in that Australian market and also even some other markets. And we also see the warehouse demand in some mature market like Hong Kong and Singapore. I think they are doing pretty good as well, and the rental growth is quite resilient. We also see something like mid-single digit growth a year, and that is also driven by a very high occupancy rate, and that occupancy rate is always like close to 100%. So that is also drive the rents keep going up a bit. And for China, lastly, I think this is a bit challenging in a situation that we also see some markets like the tier 1 cities, the demand is still pretty robust. But for some lower tier cities, we also see the supply constraint that already no longer that issue. We see more and more supply coming in those lower tier cities. So, and that means that for those logistics rents, we also see some divergence in some trailer market that is a bit difficult to see that what they can, like for some of the landlord, they have the vacancy rate getting higher, so which means that the rents for those lower tier cities, it could be a bit challenging going forward. So that is something in Asia happening.
Great, so lots of similarities to the US in terms of infill markets outperforming, stronger demand, continued rent growth. So one thing, Patrick, sticking with you, that the U.S., Prologis has built one multi-story warehouse, but it's not a trend that's sort of picked up here. But I know it's popular in Asia, and it seems to work there. So maybe you can talk about, those types of warehouses, why they're successful in those markets, what the rent structure is like, and any other things that you have.
Yes, I think the multi-story that warehouse, we also see the trends there in Asia is doing really good. And a couple of them, as I mentioned, like Goodman, they're doing really successful in that over the past couple of years. And in Hong Kong, I think they're also doing very, very good one. That in terms of the RAM assets, I think it's not just like 2 stories, 3 stories, it could be like even 5, 6 stories. And that rents, I think basically, even going up, I think the rents is not coming down quite a bit because of the rent assets is also pretty important to drive the transportation and also easy access for the warehouse in different stories. So that is something that we could see that happening in those prime city because the land supply is very limited. We also see it like Hong Kong, for example. We didn't see much demand in the past, but over the past couple of years, we see the warehouse demand very strong, but the land supply is very limited. So that also drives the rents to keep going up, and that's the part of the reason. And for other markets, like I just mentioned, even for China, some prime cities, Shanghai or Beijing or Shenzhen, that kind of demand is also pretty robust. So this is also driving some multi-story warehouse demand to happening more strong versus like a couple of years ago that when we also see some other smaller markets and which was still a bit tough in terms of getting the demand. But with the online retailing and also other things happening, we could see that the trend is still going on pretty robust going forward.
Great. Thank you. I'm going to pivot real quick to another sector that is performing relatively well, which is residential. One of the key themes that we heard kind of repeatedly over the last few days is shortage of housing options broadly, with a expensive for sale housing adding to that kind of shortage, leading to strong demand for rental housing and continued rental price appreciation. And so what I wanted to do was kind of get a look at how some of your markets are faring in that, or is the environment similar? Sue, I would like to start with you because I know that London is very different, and then some of the other European cities are having maybe a different set of fundamentals.
The London market, the purchaser market has held up reasonably well. I think today's Halifax number was probably the first time we've had an annual actually down year on year, despite what's been going on. Obviously, liquidity has dried up a lot in that market. And the result of that is that first-time buyers have found it difficult to get into the market. Obviously, mortgages are being more difficult to come by. And so as a result, there are more people renting, and that's shoring up the rental values. Also, the rental market in London has been affected longer-term trends with various tax changes that came about for landlords a couple of years ago, and that's brought quite a lot of properties out of the market as well. So the rental market in London is really, really strong, but we don't actually have very much corporate. We don't have corporate companies investing very much in the rental market. There's a company called Granger, but there aren't very many others in the UK, so it's not a market that we look at so much. One of the bigger markets for residential in Europe is Germany. And there, the German residential companies, Vonovia, Leg, and Adler and various other smaller ones have been hit quite hard. And I think that's come really more from the debt market and their credits. There have been some concerns over that and valuations. And the German residential properties can't, they have rent controls. So there isn't a sort of way out for them to raise rents, and the valuations are falling. So those shares have really tumbled quite badly. They're trading more than 50% below their net asset values. And there's definitely distress appearing in some companies. And a similar picture in Sweden. We've got one company at the moment that's sort of slightly fighting for its life, SSB. You know, it's tried everything to shore up its position, and it's not a question of it being operationally unsound. It's just the debt situation has really caused problems with the equity piece as well. So there are different sort of trends and things, and as I say, we don't have any REITs because you can't have a residential REIT in quite a lot of the European countries.
Patrick, do you have a view on some of your cities like Hong Kong, et cetera?
Yeah, so for Asia, I think like Singapore, Hong Kong, we also always see the demand is very strong. And for us, I think the interesting trend is like Singapore, because we see the money inflow, and also we see lots of population inflow from elsewhere, especially like last year we opening really fast in Singapore. So that's why we see that the rents there, the housing rents is going up. Like when you renew the rents, basically you need to pay 40%, 50%, even 60% higher. So this is really crazy thing, right? But it makes very difficult for lots of people that they move in earlier, then they figure out, wow, the rent's going up so high. And even when you buy properties there, if you are overseas investor, in the past you already need to pay at least 30% of the stamp duty. And now they just did it like 2 months ago, they raised to 60%. So meaning that if you're buying something like 1 million Sing dollar, you need to pay 600,000 of the stamp duty. So that is really crazy. But we also see that kind of money inflow is driven by mainland China. And for back to the China market, we also see that the China market is also very interesting, because the China market, we also see lots of headline news about the problems that Evergrande or lots of developers, they are struggling. So that is one major issue that we see that over the past 2 years already. And the physical market also get affected. I think over the past couple of months, we see the pricing and even the demand is softening quite a bit, and especially for some lower tier cities. So that is also affect some of the developers. They thought that they could like survive, but honestly, it also depends on how quick the policy can easing, right? Can be easing in mainland China. We see a couple of major things that happening in terms of easing, like in terms of like home purchase restrictions, and also like lower the like mortgage restrictions, that kind of thing. It keep happening, but we also see that the economy there, it may need a little bit time to improve. So that's why we also see a little bit struggle at this moment for China, especially for some Chinese developers that focusing on those smaller cities, lower tier cities, that may also be a bit affected, at least in the later this year, second half.
What about on the construction side? So that's one of the other topics that I think was front of mind the last few days on the residential owners is you know, a wave of new supply that's hitting the market this year and next that is, you know, in some markets unprecedented, and you know, really could cause the supply-demand dynamic to get out of whack. You know, especially in China, what are you seeing on kind of new deliveries of residential?
Yeah, for China, I think one interesting thing is that we see quite a bit of ample supply in different major cities, and especially in those lower tier cities, because the demand is not that strong. So, and the population outflow is there in some small cities. They all moving into those major cities, and it happened in like even other major countries before, right? Like Japan, for example. We also see Tokyo, for example, they're doing really good, right? And then some small cities, they also struggle quite a bit in terms of population outflow. So that thing also happened in China right now, I think. So, and construction activities is also meaning that they want to keep the construction flow there because it's also drive the overall economy in terms of the real estate sector and construction sector. But the challenge will be like when you build something and then we find out that the demand is not there, and then you just keep the project or lots of units vacant, that will also create another type of issue. So I think that for those small cities, we still see that kind of problem. And it's also quite a big structural problem because it will also affect the land sales. And the land sales is also the revenue for the city government. So in other words, I think it's overall situation that why China need to like ease quite a bit in terms of to save the industry for property sector. So that is very important because it also saves the economy.
So you want to talk about
Yeah, sure, yeah. So yeah, in the UK, the housing starts have plummeted quite a lot. The main house builders, and there's a big sector of house builders, have all seen cancellations of 30, 40, 50% of the people who'd already booked to have their stock. So they're really just slowing down altogether on new building starts. Similar in Germany, 25% reduction in housing starts in the first quarter. So it's really slowing down very sharply, and obviously the drivers for that are construction costs have been rising after the energy crisis last year pushed them up, and I know they're coming down a bit, but it's actually not really affecting the cost. They're still expecting sort of 10% inflation there, and then financing as well is obviously a lot higher too. And so until you understand what pricing you're going to get for your property, it's just causing uncertainty and obviously delays there. So yeah, that will affect the supply quite considerably, probably in an 18-month time pocket, yeah.
So moving a little bit to retail, which I think is a really interesting sector because the pandemic, which was obviously a very negative event in a lot of aspects, really drove more visibility into why brick and mortar stores are so important for retailers. And we are seeing a surge in demand since late 2020 in the US. There's essentially no new supply. There's been no new supply for years. So it would be interesting, and I'll start with you, Sue, to talk about, the demand for retail real estate in your markets, and also, what you're seeing on leasing spreads. Because here in the U.S., most of the sectors, if we think about like open air and even some malls, we have seen a transition to positive, and street retail, next to residential areas. But I'd be interested in your take.
Yeah, so we've got sort of three different layers of retail broadly. We've got the sort of big shopping centres, we've got retail parks, which tend to be sort of out of town, maybe more big boxy kind of places, and then within London, we've got our normal high streets and streets. So the big shopping centres are still struggling a bit, although they are starting to see rents sort of stabilise. In the UK, where we've got sort of perhaps better data, rents have fallen about 35% since sort of 2016. I mean, they really have, and this is all because of the driver of online commerce. We had far too much retail space in the UK, way too much. And so that is beginning to play out now. I'm beginning to start feeling that we're going to see some rental growth. And in some pockets, yes, we are seeing some rental growth. Certainly the ERV growth, which is the estimated rental value. I don't know whether you use that term here. It's the rent if you were able to rent a property out now. It's what the rental value would be on the property. So they're beginning to grow. British Land, for example, for its retail parks, actually notched up 6% last year. Now, some of that is coming out of the pandemic and converting some of the temporary lets into longer lets. But, at least it's a positive trend. In other areas, though, still, I think for the next 18 months, we may see some of those release spreads still negative. There were some 5 or 10-year leases, and obviously if you've seen that huge fall in rents over 5 years, then as those come up for renewal, they're still going to be at a slightly lower level. But it's starting to play out. There seems to be much more stability in the rental market there. Where it's been quite exciting has been in central London. We've got a REIT that invests in Covent Garden, which is quite an iconic sort of area, and they've got various little villages around that where they sort of took up the back streets and they curated them so that they've all got a certain characteristic. So we've got Chinatown, and we've got sort of Seven Dials, we've got Carnaby Street, I'm sure some of you have heard of that, and then Covent Garden. And there, obviously, in the pandemic, you know, there's a lot of individual, quite small retailers, and they were really, really badly hurt, but the REITs sort of held them up a bit. Anyway, that's really coming back. And London is, I have to say, very buzzy now. You know, it's really got its life back. You know, you have to book to go to any restaurant. There's queues outside shops. You know, it's really difficult to find your place on the pavement or the sidewalk or whatever you call it here. You know, so I'm sort of believe that's better, but of course we've still got a potential recession coming. If you look at the macro outlook, you know, for the UK, it's sort of, you know, for Germany, UK, and Sweden, I think they're the worst ones, sort of negative this year, but only just, you know, up to 0.5%. And, you know, we're never usually that accurate with our forecasts anyway. And into 2024, we're sort of 1% for those economies, better around the rest of Europe, admittedly. So it's very, very sluggish. But if it stays positive, then I'm a little bit more optimistic. But there is a possibility, obviously, that something would happen and we'd go back into recession. And so it's still quite vulnerable, but it is looking a little bit better.
Yeah. And then for Asia, I think one interesting point is for Hong Kong, the most interesting one, it will be retail at this moment, because we see the reopening trigger lots of inbound travel, like have the tourists back to normal. And the retail sales, what BI we are forecasting is that this year we could see retail sales in Hong Kong will increase by 30%, 30. So this is really good because we also see kind of the demand also driven by the tourism and drive those luxury retail sales momentum and also the shopping mall demand. And that the leasing in those market, I mean like in some of the tourist spots like Tsim Sha Tsui, for example, that is a very strong momentum we could see in terms of the leasing. And the occupancy rate also getting higher. So that is also one positive things we could see for the landlord. And even for the mass market, I think we see link with that is one of the largest REIT in Asia Pac, right? So that one is also very strong because the occupancy rate now is going to a record high level. We never see that happen before. It's now is at 98%. So that is also a very high level. And we also see the rents also going up quite a bit in terms of the like high single digit level percentage versus like 2-3 year leases before. So I think the rental growth momentum is going back to normal. So in Hong Kong, I think that is something that we could see. And this also translates to other markets like Singapore, for example, and the tourism also back to a pretty good level and also drive the rental growth there. And then otherwise like Australia, I think it's also another interesting market because the lease structure also means that they are pegged to inflation quite a bit. And the inflation pressure there, we see that's why the interest rate also keep going up. And for the retail sales and also the retail rents, we could see that is also in a pretty solid mid-single digit growth there in Australia. So that see that overall the Asia market, I think the retail momentum is overall is quite positive.
And Patrick, in Asia, the rent for most retail is based mostly on sales, tenant sales, correct? Because in the US, I think a lot of the REITs have done a lot of work to shift as much as they can to a base rate per square foot. So a lot of your commentary, the 30% is a lot of the rent growth is coming from that increase in sales.
Yeah, I think it also depends on different segment because like luxury market, for example, they are really going to have a really high turnover rent portion. So that is very important for them to drive the rents further. So that's why the luxury rental for the retail, it also translates into a better rental growth momentum. Versus so like suburban mall, they still quite rely on the base rent. So that's why, yes, the retail sales may grow quite a bit, but the rents may take a little bit time to go up further.
Okay, great. And I wanted to ask one more question on retail, and Patrick, I'll start with you. I want to ask about sort of emerging trends, because a lot of times, in retail, the Chinese consumer can lead the way on the future of how and we like to shop, whether it's online, apps, whatever. So maybe you can talk about emerging trends you're seeing in Asia and how you might think real estate could adapt.
Yeah, I think one interesting I can share is in China. So they always do lots of things very innovative. And one thing I could share is about the payment, because in the past, I think people right here you use the credit card or whatever, right? So in mainland China, we also move on into a system that we don't use cash, right? And we use mobile payment quite a bit. So we use our Alipay, WeChat Pay, that's it, with the QR code, we pay everything. So that is really happening already. And then what more interesting that is the government, they also adopt the digital currency. And that is also a new trend because it also means that the government can track everything, right? But in other words, I think it's also really successful means that they move on from the cash, use of your cash, and then it makes very interesting situation that for people, they need to rely on the mobile phone quite a bit. So that is something that I think is a big changes. And it may happen to Hong Kong in the future, I guess. In terms of like in Hong Kong, I think if you go Hong Kong and take the taxi, you need to pay cash. So that's something really challenging for lots of people. But lots of them, they don't accept credit card. So that's a major problem in Hong Kong. And something that I would say that in the future, if we also have the digital currency happening, that makes the taxi, they need to accept that thing. But in other words, I think back to the thing is that for the retail, right? And with those use of the mobile payment, I think for the landlord perspective, or retailers, they can easily track about those payment transactions. And then for landlord perspective, they also easy to charge those rents by turnover more easily, because people will also doubt if you charge by cash, right? Whether your turnover statistics is really correct or not, right? So that kind of things we also move on for the landlord perspective will be much easier.
Yeah, when we were talking about rents there, actually, what I didn't say was that the European leasing is mainly indexed to a sort of CPI figure. So they've been putting up their rents, and that's been obviously helping all the REITs across all sectors, but certainly in retail as well. There was a bit of a question mark because, if the retailers were facing high energy costs last year, would the landlord be able to pass those costs on? So far, they seem to have been able to do that reasonably successfully. So, in France, for example, that's running at sort of 5% or more. And in various other countries as well. That's on the rents. In terms of trends, well, there are various different trends. In leasing, there are trends in the sense that the mall operators are really trying to bring in lots of different kinds of occupiers. So you've seen services really come into malls, your dentists, your doctors, beauty parlors, salons, and all those sorts of things. So that's been a trend, and we've for years now, there's been quite a lot of F&B in the malls too, and cinemas and other sort of leisure aspects to them as well. So that's one trend. But actually a different sort of trend altogether has been, which again is across all European property, is ESG. It's very, very important. If your property is not moving towards net carbon zero, then it's going to become increasingly difficult to get tenants. In the UK, there are already ratings in place that came in April that you had to have a certificate. I mean, it's only a low bar at the moment, but that's moving up so that it's environmentally friendly by 2030. And to give you an idea, Hammerson, one of the UK-based retail REITs, opened its first net zero carbon retail park. I think it was in 2017. So, this has been an issue that has been going on for quite a long time. And the Europeans, I would say, certainly at the REIT level, are really sort of on top of the environmental piece and doing what they can. And that includes Scope 3, which for a mall is quite difficult because you have to then include all the people who've come into the mall and the transport to do that. And, so that's all becoming important. They're putting in electric chargers and various other things too. So, yeah, then that's a big trend.
All right, so we're going to shift here and hit the elephant in the room, which is office. Obviously, significant concern in the marketplace about the ability to lease office space, what the dynamics of what cash flow dynamics are going to look like, just in general, what demand for office is going to be like in the future. Although I guess if you believe some of the management teams that were presenting and speaking over the last couple of days, everything's fine for their portfolio. So maybe there really is truth to the high quality versus lower quality portions of the marketplace. But what I would love to kind of discuss is what the office. We read about it all the time here, right? What is going on in the office market, especially markets like New York, San Francisco. What's going on in the big cities, London, Hong Kong? Are we seeing the same kinds of things?
Should I go first? Yes, the sort of work from home thing or return to work is seems to be settling down a bit towards a sort of 3-day week. And I think that most people believe it's here to stay in some form or another. And that really means that we're sort of looking at around about 20%. Well, the number that people are talking about is about 20% less demand for office space. That's obviously translating into vacancy. It does depend that, they do vary quite a lot. So, for example, London, West End, sort of high 6%, but in the city it's over 10%. In Paris, the periphery of Paris is about 15%. And it's, very, very minimal in the center of Paris because it's been supply constrained for so long because, the buildings are all listed. And then in other cities as well, Berlin wasn't so bad. So we've got that happening, but actually that just, that's an average. And it's really disguising what's going on underneath. So what's going on underneath is, to go back to that ESG point, is that the buildings that are environmentally friendly are filling up and new and modern and have facilities, amenity rich, I think is the term. Those buildings are filling up, but also they're filling up if they're only still on site. The pre-lets are very strong, whereas about 80% of that vacancy is in the secondary market, unrenovated buildings where the ECP ratings aren't very good. So that's the sort of basic. I mean, rents in the top end are actually growing a bit. They grew sort of low, mid-single digits last year, and I think the expectation is some growth this year, maybe 3 to 5 if things go well, slightly lower than that otherwise. So there is rental growth in the markets, and the same in Paris. But, outside that, if you haven't renovated your space, it's not looking so good.
About some of the major Asian markets.
Yes, sure. So for Asian market, we also see very interesting trend, especially about the return to office, which supposed not to be an issue, right? In Hong Kong or in Tokyo, where lots of people think that this is like the home there are really small, so people will just work in the office, not staying at home. But interestingly, we just did a survey. We have a BI survey about the working pattern for those workers in Hong Kong and Tokyo. And then we found out a very interesting trend is, first of all, about 2/3 of the survey respondents, they found that they really love to have more flexible working arrangement. So that is really surprising to us, because it means that for lots of employers, they will need to figure out how they can adjust a little bit in terms of the working arrangement for the employees. And it also means that for some of them, they also eager, in terms of our survey results, they are actually asking for the employers that if we are going to have 5 days a week working in the office, then you gotta raise our salary by like 10% or even 20%. So that is also really surprising to us, because in the past, I think, especially in Tokyo, I think people really love to work in the office every day. But we also see that kind of structural change, with part of the reason about like the new generation, and also about the pandemic. That is kind of the change that it also changed quite a bit about the work-life pattern every day. So this is also a very interesting issue. For Hong Kong especially, we now see the vacancy rate is almost like 15%. So that kind of 14-15% level is a record high level in Hong Kong, and we never see that. So the question come out is whether it's a structural change or it's a cyclical change for us. But it looks like there is also a mix of them, and that could be a structural issue about like if some of the banks there, we also see they are moving to the hot desk arrangement, because some of the colleagues, they just like working in the office like 2 days, 3 days, and it makes sense to change the like hot desk arrangement for them to save, like maybe they have 10 floors, they now can cut 3 floors, even 4 floors, that kind of thing. So it already translates into a downsizing in terms of the office demand, and it really happened. I think especially for now the interest rate is getting higher, so for the corporate perspective they also think a little bit about the cost savings rather than raise the salary to attract the people working in the office for 5 days.
So that's a nice overview of the kind of the leasing and the demand dynamics. What about the capital availability, right? So that's the other big issue here in terms of kind of office investment, both on the debt and the equity side. And I think it really took off after the kind of the beginning of this banking crisis that we're in terms of who might be willing to put incremental capital into some of these buildings and what that might mean. What's going on in terms of capital availability investing into office?
Yeah, so the UK REITs had to go through Brexit. And at that point, they all started deleveraging. And so they have got, we use a loan-to-value ratio because their properties are marked to market every 6 months. And the covenant is typically around 60%. And they were all down in the sort of 20s, 30s. Valuations have gone down. I think we're going to talk about that in a minute. But so they're now sort of probably around in the 30s. Over in Europe, the LTVs were higher, typically, and so a couple of years ago when we had the pandemic, there was then a real rush to try and bring the leverage down a bit. So they were making disposals and keeping the cash to bolster up the balance sheet. So sort of mid to high 30s, early 40s is what we saw when we came into the interest rates rising. We don't normally do too much on the net debt to EBITDA, which seems to be a ratio banded around a lot here, but we look at interest cover from your cash earnings, that's excluding any capital gains or losses. The covenant is usually about 1.25. Quite a lot of them were 4 or better. So, from a cash perspective, once we got out of the pandemic and everyone started paying rent again, that ratio looks pretty strong. So they've gone into it not that badly, but on the corporate credit that's listed has not been a good picture, as I alluded to earlier, with the debt for the German residential properties. So those markets are open, and we have seen a bit of issuance. But obviously, the strategy, what most of them are trying to do is use their already arranged, usually an RCF, but there may be some capacity in some of the other loans in their cash balances to fund what they need at the moment. And we're even seeing quite a lot of companies who want to continue with their development using their RCFs to fund that, which obviously isn't a sustainable long-term solution. But I think it's in the hope that interest rates come down in the next year or so, and depends on which economy you're in, whether that's a sensible decision or not. But they're starting to use that RCF for funding for their development, if indeed they're doing it. So that's something to watch, I think. But their loan-to-values are all right at the moment. If values plunge another 20%, that might be a different story. But yeah, the REITs are generally all right. I think in the broader market, though, inevitably there will be some distress, but the REITs sort of seem to be in better shape.
Yeah, for Asia, I think we also see the situation that the loan-to-value ratio for lots of the major markets like Hong Kong, for example, is relatively low for commercial properties. So for office, so that's why it also means that the they have some buffer, at least for the banking perspective. They are not really too concerned about the capital value, like already down like 20%, 30%, but still have some buffer. And interestingly, I think in Hong Kong, for example, we also see I think one problem we have now is about like how some distressed office that properties basically they held by those mainland Chinese corporate, and they have the China property crisis happening last year, so they run out of cash and then they need to sell the properties in Hong Kong. But it also a bit challenging because the Hong Kong, the office market is also not that positive, and it means that the bid-ask spread is there, and then distressed office also means that. Interestingly, in Hong Kong, like, the cap rate is so low, like 3% for office for now, but it could also be expanded quite a bit if that kind of distressed asset to be sold. So I think the risk is still there, and then we need to keep an eye on that, especially for second half.
And so that actually kind of leads us, I think, into a more broad conversation about the kind of the valuation, like where are these properties, what are they worth, what are they actually trading for, what should they be trading for? And John, actually, I want to kind of bring you in to the conversation because obviously in the U.S., REIT share prices, especially on office, but in general, are pricing in a major decline in property values that hasn't materialized yet. Can you kind of give us some research that Nareit's done in terms of where that is now, what it may look like in the future, and then we'll see what.
Absolutely, and this really, didn't come as a surprise, right? We've seen historically when we have big shifts, and I think here we're seeing mostly the impact of the change in the rate environment. Historically, what we see is that the public markets, REITs, are going to lead private markets, and that lead lag period can be anywhere from a year to 18 months, and sometimes even longer when you get a very meaningful shift. And so we saw at the end of the third quarter, we had one of the largest negative valuation gaps for REITs versus private real estate in the data that we have. We had a 38 percentage point gap between 12-month rolling returns between REITs and private real estate as measured by the open-ended core funds. Interestingly, that's narrowed over the last 2 quarters, right? We've actually seen as REITs have been, about neutral over that period, and private real estate has started the process of pricing in some declines. But there's still, if we look at that 12-month rolling return, we still have an 18 percentage point gap. When we look at cap rates, we see that there's still quite a bit of adjustment to go. And, that would require, very meaningful decline in private values, on the order of 20%. And I think, but historically, what we see is that, that's not the way the markets typically adjust. We're going to see some give and take where we're going to typically see REITs start to recover, private real estate continues to price in the higher rate environment. And that's why historically, when we're at periods like this, what we see over the next 12 months is pretty good REIT outperformance, and sometimes exceptionally good outperformance, both versus private real estate, which I think at this point is basically baked into the arithmetic of the cap rates, but also often versus the broader stock market. So, and I think you can hear some of that in what we're hearing from management teams, that they're feeling like there is a period of opportunity sort of around the corner as they are feeling the strength of their balance sheets. They've got access to both debt and equity markets, and feeling that as we see transactions pick up, we will see private values start to come down. We'll see that bid-ask spread between buyers and sellers closing up, and there's going to be opportunity for REITs, I think.
Right, but at the same time, you've got implied cap rates on the REIT side that are above where the cap rates are on the private real estate.
Absolutely, and we know these are fundamentally the same assets. Often in the case of REITs, better quality assets when we get into some of the property sectors. So we know that is really valuation process, not actual reality, and so that gap has to close through time. So
obviously the accounting is different outside of the US versus what GAAP requires. So your companies are already marking their assets to market. Can you talk about what you're seeing and what that might mean for us here?
Yeah, so I mean, it's different across Europe, actually. So transaction volumes, let's start from there, have plummeted. And obviously, properties are valued partly on what you see in the transaction market. And so there's not very much evidence out there of where we actually are at the moment. And obviously, the bids and asks for individual property are still far away from each other. In the UK, the third-party valuers for all the REITs properties include a fair chunk of sentiment in their valuation. And so they have marked, offices 100 basis points spread over the last, expansion over the last year. For industrial, it's more like 200 basis points, 175 to 200 basis points. And for malls, it was slightly different because, they were already distressed, so they were already on higher yields, and therefore 50 basis points has a much lesser effect, but they're still down. So in the UK, we've seen declines, certainly well into double digits. But there's obviously two parts to the valuation. There's the yield, and then there's the rental value. And as I said, the operational sides have been quite strong. So where we've had indexed rents pushing rents and their estimated rental values up, where a company has been able to generate reasonable rental growth, that's partly offset the effect of those huge yield shifts. But nevertheless, it's gone down. So, for example, I used London Metric a little while ago because these are the March year ends and it's the freshest sort of information that we have. Their valuation was down 16%. That was off ERV growth up over 11% and, near enough a 200 basis point yield shift. So, it does help, but you've got to have an awful lot of rental growth to really sort of affect the size of some of those yield shifts. Obviously, what we'd seen for industrial property is that it had accelerated, that the growth had gone, way up in 2021. So we're now back to, after that fall, down to about 2020 values. In offices in London, as I said, we're down again, it depends whether city or West End, sort of 14 to 15% in the city, probably around about 9 or 10 in the West End. And, there's more to come. I mean, the CEO stand up and say the resetting is continuing. And since March, we've had another couple of interest rate hikes. There may well be more. We think we're going to peak maybe in the next one, hopefully. But core inflation in the UK is very sticky at 6.8% at the moment. So that's not looking very good. But obviously some of it will come out of the equation. So yeah, that's where we're seeing things. In Europe, it's different because they tend to just look at evidence, and there's no evidence, so they're moving far less. And obviously they've got this indexation. So we'll see, but I suspect we've got some resetting to come over the next year or so, but it just depends on how things go and how inflation is, whether it can be tamed a bit better in Europe than it is in the UK.
Patrick, you want to touch on property value changes in Asia, and then maybe we'll kind of open it up for some Q&A.
Yeah, sure. So very quick for me is that for the Asia market, lots of the variation of the REITs is they're using relatively low cap rate at this point, and like 3%, 4%, that kind of thing. And the challenge, I think, for lots of those valuation perspective is that the transaction, the physical market is also looks like at a relatively low cap rate. So that's the things. But versus the REIT, I would say that because they are already trading at deep discount, like usually trading like 30%, 40%, 50% discount, we also see that. So that thing also means that the implied cap rate is relatively high. And the concern, I think, now is whether the physical market will really come down further, right? Or actually it's about the public REIT is trading relatively cheap at this level. So I think for office, maybe particular challenge, as what we mentioned about the vacancy rate is so high, and also the cap rate, the thing is still at low level, and then we have some distressed office that being sold could be like in the second half. So that thing will also affect a bit in terms of the valuation perspective for lots of the risk may be very down further. And so that will be a concern.
Great. Before we kind of move on, does anybody if anyone in the crowd has any questions, we'd be happy to take them. Yes, sir. So the question is about Hong Kong office cap rate trends.
Yeah, so good question. I think the past 5 or 6, 7 years, we see lots of the mainland money, mainland Chinese coming in to Hong Kong. So it triggered the rate that the transaction price is at a very high level. And then the rents is trending up a little bit, but it's not really aggressive trend. So we see the capital value is going up faster. So that's why the cap rate also keep depressing at a relatively low level, only like 3% at this point in time. And the funding cost, I would say, why now is, as I said, there is lots of concern about Hong Kong office. And then how come the cap rate still at this level, at this point? I think part of the reason is about the China easing that we happened since November last year. And it also means that the funding cost in Hong Kong, because suppose Hong Kong is all pegged to US, right? So when US going up in terms of interest rate, it will also affect the market. But in reality, we see the China easing. We also see the money inflow to Hong Kong as well. Even they are not moving into the Hong Kong office at this point, but they also make the half the interest rate increase is much lower than what we see from the US. So that's why it also makes the cap rate at this point still just like 3%. But having said that, as I said, if there is lots of distressed assets coming in the pipeline and then you sell at a relatively cheap price, right? Then the cap rate could expand quite fast at this point. So that it could be a potential risk for the Hong Kong office in the second half.
I guess one last one, because we have a couple more minutes, is John, do you want to talk a little bit about ESG broadly and REITs? Obviously, there's a higher focus. In the US, we seem to be a little bit behind Sue's companies in Europe. What are REITs doing to work towards these goals? Anything on ESG?
Sure, happy to talk about it. And I think when it comes to sort of that bundling of sustainable, social responsibility, governance, I think probably both the REITs, listed real estate companies, as well as the investors are somewhere behind Europe and maybe ahead of Asia in terms of both investor interest and in terms of where some of the companies are. We've seen a tremendous amount of progress in the U.S. We just put out our ESG dashboard, which sort of compiles public reports from the top 100 REITs, and for the second year in a row, we have 100 out of the top 100 reporting on ESG, and we've seen the depth of that reporting continues to grow in terms of reporting on goals, starting to report on energy usage, and some of the as well as deeper reporting on all the social components. So we think it's a place where, as investors are looking for to work through the ESG components of their portfolio, just like with property sectors and geography, we think sustainability, social responsibility, governance, these are places where investors who want to improve their portfolio can go to best-in-class REITs. We've seen certainly that REITs are by some metrics outperforming private real estate in terms of their GRESB scores. So it really creates an opportunity for investors who want to complete their portfolio to do it in any one of those dimensions, including sustainability.
Obviously, it's been covered. I apologize, but every meeting AI has come up in the conversation in all our meetings that we've had this week. What are the London REITs and Hong Kong guys? How are they saying that AI can potentially impact their operations?
So the question is about artificial intelligence, and rather than turn it over to Sue and Patrick, why don't we just pop it into ChatGPT and see what the answer is? Sue, do you want to take that?
Actually, AI, I suppose it's going to manifest itself quite a lot in various apps and sort of controls of the buildings. I think it's probably more that side. I've had several people asking this question, and I was lucky enough to be able to have a conversation with architect behind the Bloomberg building in London, Michael Jones from Norman Foster Partners, he's a partner there. And we were talking about AI the other day, and I think we sort of felt that certainly for, obviously for visuals it's helpful, but we've had loads of programs for that already, but in terms of leasing agreements, those sorts of things, it can be helpful. And we will find other ways, but actual architecture he was very protective about, as you can imagine. And yeah, I guess maybe it's probably more the greater area, what's going on around the buildings, autonomous cars, how that affects how we use the property more than the actual properties itself. And obviously they're going to have to adapt to have all charges, which we're already working with, and there may be other things as well. And more broadly how cities develop as a result of AI too. But it's very much nascent at the moment, and it's not a topic that we're hearing coming up too much yet in the company presentations.
Yeah, just very quick, is the innovative buildings, I think it's happening quite a bit in like China, Hong Kong perspective. It could be a really important trend to see the flight to quality buildings, that the new buildings, the amazing one, that ESG focus will get more and more demand. So that is something that will be very important.
Okay, well, I think that we're being flashed here, told to wrap up. So I just wanted to thank John and Nareit for participating and for having us, and Sue and Patrick for joining us from across the various ponds. And thank you all for spending such a late hour with us and pushing off your happy hours, and enjoy the rest of your conference. Thank you.